All right, so you should be on here for a crop insurance decision webinar for 2014. This is for Maryland. I want to welcome you to this webinar. I'm Gary Schnitkey, and I'm from the University of Illinois, and we're doing this webinar actually from University of Illinois, Mumford Hall this morning. We have nice weather here, 50 degrees supposed to be today, and snow tomorrow, so I guess we're not quite done with winter yet. Again, you should be here for the crop insurance decision webinar for Maryland. This is a result of a number of your sponsors, but Lori Lynch was the one that arranged it. And so if you think this is good, it was Lori's idea. We're going to get started here now. Again, I'm Gary Schnitkey. Let me see if I can advance the slide. Oops, there we go. Just a couple of notes here. If you want to look at our presentation material, if you go to the downloads page of farmdoc.illinois.edu webinar, which you should be seeing right up now on your website, farmdoc.illinois.edu webinar, you can get a list of the PDFs of the slides available there. So if you want to follow along with the slides, those are available. Also, this webinar is being recorded, so if you want to look at it again, the video of this webinar will be available tomorrow. And again, you would go to the same website, farmdoc.illinois.edu webinars, and we'll have the webinar available to tomorrow. We are going to take questions during this webinar. In fact, I'm going to present for about half an hour. Then we will take your questions, and as we're going through this, if you have questions, just type them in your questions or chat box, which on my screen is on the right-hand side. So, if you have questions about what's going on or have questions about crop insurance, please submit those in the chat or the question box on the right-hand side of your screen. Again, this webinar is a result of sponsorship from University of Maryland Extension and the Center for Agriculture and Natural Resource Policy, again at Maryland, and it's being supported by the Risk Management Agency and the Maryland Department of Agriculture. Again, Lori Lynch gave me a call and said we did a webinar, a general webinar for the Midwest and the U.S., and said could we tailor it more to Maryland, and as a result of that we are doing this here this morning. And again, if you have any questions or comments for this webinar, just type them into that chat box. We are going to cover three topics today. First, we're going to talk about the impacts of the 2014 Farm Bill on crop insurance decisions. The short answer of that, and my answer to that, is it really should not impact your decision for 2014. So if you're thinking that the 2014 Farm Bill made the 2014 crop insurance decisions more complicated, it hasn't, and we'll discuss that a bit more here in a bit. Then we're going to talk about performance in 2014, and I'm going to show you what crop insurance policies were bought in Maryland for both corn and soybeans, coverage levels and products. We'll talk about what the payments look like over 2014 as well as a longer period. Then finally we'll look at the products and look at the situations in which the products fit an individual situation. So that's the outline. Again, 1, impacts of 2014 Farm Bill, 2, performance in 2014, and then 3, finally, product recommendations. As far as the impacts of the 2014 Farm Bill, the 2014 Farm Bill made no changes to crop insurance for the 2014 crop year. So the bill passed, but it had no impact on the products that you have available in 2014, and it did not impact the cost of those products in 2014. And in fact, even in future years, the 2014 Farm Bill does not change the combo products that you have available to you. RP, revenue protection with harvest price exclusion, and YP is not influenced by the 2014 Farm Bill. Also, the 2014 Farm Bill did not change the subsidy rates. So if we're looking at the premiums that farmer pays for the products, they are not, the 2014 Farm Bill did not impact those. Those premiums are going to change over time, and it's going to change over time because of loss experience. It's going to change over time because of projected price and volatility changes, but it isn't going to change because of something that happened from the 2014 Farm Bill. If I were looking at the 2014 decisions, I would say that the 2014 Farm Bill does not impact those decisions. And in fact, I would make the same decisions now that I did in 2013 under the old Farm Bill. The linkages between the new Farm Bill and its impacts on decisions in 2014 are pretty not that close to one another. I've had a number of individuals ask me if I'm going to take a particular commodity program such as ARC, should I have let that impact my crop insurance decision? I would not at this point, and there's a couple reasons for that. One is you may change your choice on product. Two, I'm not sure that those product choices are going to, the commodity choices will impact your crop insurance choice as much as we may think now. And three, even if you do sign up for a particular commodity price program for the 2014 crop year, you're not going to get those payments till 2015, at the earliest in October 2015. So in essence, I would not let the 2014 passage of the 2014 Farm Bill impact my decisions for crop insurance in this year. The 2014 Farm Bill did make a couple of changes, and these will be introduced in 2015. First thing it does is introduce conservation compliance for highly erodible farmland. This is new, so to purchase crop insurance you will have to be on conservation compliance on highly erodible farmland. As we understand those requirements now, those would be the same for the commodity program title. So if you have highly erodible land and are in compliance for the old commodity programs, that would be the same for crop insurance. The second thing that it does, that the 2014 Farm Bill does, is introduce the supplemental coverage option. Again, this will be for the 2015 year. That is not available now. So it's not something that we're going to spend a lot of time talking about today because it's not available, and it offers a county. What supplemental coverage does is offers a county product from 86% coverage level to the coverage level of the combo product. If you want more information about that, there is going to be a webinar dealing with that tomorrow, March 12th, and that will deal with SCO. But again, that isn't available for the 2014 year. Again, the passage of the 2014 Farm Bill does not have any impact on 2014 products, and I don't think it should have any impact on the 2014 decisions that you make. It may in future years, but why buy tomorrow's problems? Let's just focus on 2014. Now we're going to turn into the products and how they have performed in Maryland. Again, we have 3 products for insuring both corn and soybeans. Revenue protection. Revenue protection is a farm level product. It has a revenue guarantee that will increase if the harvest price is above the base price. RP with the harvest price exclusion is again revenue protection, but its guarantee will not increase if the harvest price is above the base price. And then YP, yield protection, is a farm level product, and it will insure against yield. So YP is a yield insurance, RP is a revenue insurance, and HPE does not is a revenue insurance that does not have the harvest price increase in it. These products were available, the same products were available in 2013, 2012 for that matter, so they've been around for a couple of years, ever since we've had the combo product introduced. And here is the use of those products in corn, Maryland in 2013. So this gives you a feel for the products and their use in 2014. And we have a column for RP with harvest price exclusion, and YP here. If you're looking at acres insured in Maryland, 73% of the planted acres were insured in 2014. This is that 73% is lower than it is for in much of the Midwest. So in Illinois, that percentage would be over 80%. But the majority of those acres, and this 60% here is of the acres that are insured, 60% of those products acres are insured with RP, revenue protection. We actually have 0% for RP with harvest price exclusion. There are acres insured with RP with harvest price exclusion, but they don't make the percentages. We would have to put another decimal there, and YP with 13%. The coverage levels that are most used are 70, 75, and 80%. So 70%, we had 18% of the acres were insured, 75, 24%, and 80, 11%. So if you're looking at where Maryland farmers are insuring their acres, it's RP, 70, 75, and 80%. If you're there or using that RP product and at those coverage levels, if you were happy with that choice in 2013, it's a perfectly good place to be in 2014 as well. So if you liked RP, and in fact that's the product that I'm going to say fits in most cases, if you're there, then that's a good place to be for this coming year as well. Here are the acres insured in soybeans. Again, you see something very similar to corn. You see we see that most of the acres are insured with RP, 64%, and 70, 75, and 80% coverage levels are where most of those acres are insured at. This data for both this slide and the previous slide are from the Risk Management Agency, their summary of business, and that gives us insured acres, and we also get data from NASS on planted acres, so to come up with these percentages. If we're looking at what farmers have done over time in Maryland, this overhead shows RP use for corn in Maryland by coverage level. So the red line here is for 70 and 75% coverage levels, blue line 65% and less, and 80 and 85% is the green line. What we have here is from 1999 through 2013, percent acres used in RP, and by the way, RP does not go back to 99, 2000, 2001. We use the previous products, CRC, RA, and the previous revenue products in constructing this slide. Here, there's a couple of things that we want. What I want to point out here is we've seen use of 65% and lower coverage levels going down over time, particularly in more recent years. 70 and 75% increasing, and 80 and 85% increasing. What we've seen as farmers in Maryland, and for that matter over the entire United States, switching from lower coverage levels to higher coverage levels. And there's a number of reasons for that. Obviously, we've had some higher prices since 2006 on a number of these crops. We saw enterprise units introduced in 2008, which we've seen farmers use enterprise units and then increase the coverage levels on those, and cost have increased. So we've seen a more risky environment, and as a result of that, seen farmers increasing their coverage levels. So the net result of this is that if you are a farmer and have over time migrated towards RP with higher coverage levels, you're fairly typical, and that's also a place that we're going to talk about as probably a pretty good place to be for this year as well. So that's the history of crop insurance use and how it's changed over time. Now just a little bit of discussion of how crop insurance is performed. Here, this slide shows performance in Maryland for RP for 2013. So again, this is from summary of business data that RMA produces. What we have is each coverage level here, and then we show what the average farmer paid premium was in 2013. In 2013, the 80% coverage level was $21.33. We see the indemnity payment, $13.90, and we see the payment minus premium. In this year in Maryland corn, we had less indemnity payments than we had farmer paid premiums, and 18% of policies paid premiums. You'll note here that the 85% policy earned a higher proportion of those policies earned premiums. And again, if we go back to that year, we saw a substantial drop in price. If you didn't have a good yielding year, we saw a lot of payments across much of the Midwest because of that price decline. One note here is that this is the summary of business as of February 26th. These numbers may increase as we go through time. So we have a similar slide here for soybeans. Again, similar type of thing. Shows farmer paid premiums minus indemnity payments minus premiums. Again, the 2013 looked like a relatively low year, payment year for indemnities in Maryland, probably because you had some, what looks to me like some fairly good yields. I'm showing now here payment minus farmers paid premium, and again, this is all products. This is corn, and this is average per acre from 2008 to 2012. So this is payment minus farmers paid premium. Over that entire time period, most counties had positive payments minus farmers paid premium. That by design should happen because of the way the products are rated, and so when RMA sets out to determine the premium for the product, they set it equal to what they expect the payments to be with a little bit of reserve there, and then that premium for that product is subsidized by the federal government. So if you take into account the subsidy over time, farmers should pay less into the product than they get out of the product. Here's what's happened since 2008 through 2012 for corn in Maryland. Here's the same thing for soybeans. So, and for whatever reason, Queen Anne County is, if you're from Queen Anne's County, it's listed there at the bottom. It didn't want to show up on my map. 171 for Maryland. All right. So that's the performance over time, and again, what we typically see over time is that farmers receive more than they pay in. Again, that's as a result of the subsidies of the premiums. Again, RMA sets the premiums on these products so that they are roughly equal to what is expected to pay out, and then the subsidies cause those to be what farmers pay to be less than those premiums. changes for 2014 in the RP with harvest price exclusion, here's the big change that you're going to notice, and this isn't actually a change in the product itself, but just a change in the way prices have evolved over time. The projected prices will be much lower in 2014 than they were in 2013. And here's an example for corn. 2014, the projected price for corn has been set. It's based on the February average of the settlement prices of the December CME corn contract. It was $4.62. Projected price last year was $5.65. So we can see there that there's been a drop of over $1 per bushel. That is going to result in much lower revenue guarantees this year than last year. So if you take a 80% coverage level in 2013, the guarantee for RP, or the minimum guarantee, would be in 2013 $5.65 times your trend adjusted APH yield times that coverage level. $5.65 going down to $4.62 will cause those guarantees to go down. As a result, you're going to have much lower per acre guarantees. Let me just give you an example of this. This example shows for a specific case, this is a revenue protection premium in Queens Anne County, enterprise units, and this should be a $4.62 projected price. But here's for 80%. We had a 1876 premium in 2013, slightly lower in 2014, or 1375. Actually, that 85% is down significantly from 2013 levels. So we're going to see lower premiums in 2014, but our per acre guarantees are going to go down as well. So the 2013 guarantee would be $646. This year it's going to be $529. Again, this going down is because of the lower projected price. When I look at cost, at least in the Midwest, and I primarily look at Midwest cost of corn and soybean production, our cost in the Midwest did not come down in much from 2014 compared to 2013. So even though we have lower guarantees in 2014, our cost on a per acre basis are going to be at the same levels roughly as in 2013. We may see a little bit lower cost due to lower fertilizer prices, but not to the same extent that we're seeing those revenue guarantees come down. That is going to result in again, that lower projected price. Prices, or the harvest prices, will have to come down much further this year, or will be lower this year to generate payments. And here I'm just giving an example here. 85% coverage level, we would have to see a $3.91 price before there is a payment this year. So if we're our harvest prices would be below $3.91. $3.68 for an 80%, $3.45 for a 75%. Again, most of those, before we're triggering payments, those prices, unless we have extremely excellent yields, would be in a loss situation in most cases. Here's what we are recommending, or here's it, turning next to the products. You'll notice that most of your crop insurance sales were in RP last year at fairly high coverage levels, 70, 75, and 80% were the majority of them were. That is actually a very good place to be, and if you were there last year, we would suggest staying there this year. we would suggest that you take a good look at enterprise units, and enterprise units is all in one crop and all in a county. Again, taking a look at that enterprise unit, because if you move to an enterprise unit, you will have lower premiums than if you use the optional or basic unit. We would also suggest using the trend adjustment APH yield endorsement. That will be advisable in the vast majority of cases. The only case where that isn't a good alternative is if your yields or your APH yield is set near the yield floor and you're using a lot of plugs, not your farm's actual yields, in determining the trend adjustment APH yield. We would suggest being there, and this is a good place to be. It works well with most farmers, and it is the most expensive crop insurance product, but it does offer the most protection. We would also suggest to not lower coverage levels from last year. Again, we've heard, or I've been asked a number of times, you know, this year we're going to see lower projected prices. Should I try and save money by lowering my coverage level, thereby lowering my premium? Again, we would suggest, or I suggest, not doing that, and the primary reason for that is that even though prices have come down, costs have not. And we haven't seen, at least in the Midwest, non-line cost of corn coming down or soybeans, and we haven't seen cash rents come down as well. So they're still up there. Even though prices have come down, we're still at pretty high levels as far as cost, and that means that even with lower prices, we actually are in a much riskier situation. If anything, I would suggest increasing your coverage level from last year, this year, increasing the coverage level this year over last year. Again, the same coverage level is going to offer you $100 less in per acre guarantees. Your costs haven't changed. Even if you're at the 85% coverage level, my guess is that most farmers would be in a loss situation before the crop insurance makes a payment. We again would suggest enterprise units. That is, enterprise units. Here is a slide. This shows for Queens and County premium cost for enterprise, basic, and optional units. This comes from our 2014 crop insurance decision tool. It's available for download from FAST or the crop insurance sections. It will give premiums for Maryland. We see here $18 premium, and this happens to be a 100-acre unit. Those premiums will vary also by acres in the unit. $18.76 for an enterprise unit. You can see that that's significantly lower than either the basic or optional units. Enterprise unit is all of one crop in a county. So, and you also need to meet other eligibility requirements, which crop insurance agents will know. Essentially, you have to farm in 2 sections and have a minimum acres in each section. If you're eligible for that for a crop, take a good look at it. The other units are basic and optional. Basic is a division of one crop by ownership split, so all your owned and cash rent land will be one unit, and all your share rent landlords will be an additional unit. Optional units are divisions of that basic unit. If anything, most of the time I see people either going enterprise units if that's available, and if they don't do that, to go to optional units. And optional units actually often don't increase the cost that much more than basic, but if you divide up farmland into township sections, you'll often trigger some higher payments. Of course, that comes with the additional issue of much larger yield reporting requirements. So if the more you break it down, the more documentation you're going to have to provide as far as breaking yields down into smaller units. Here's an example of the RP guarantee, 462 this year, 143 APH yield, and that guarantee, and I used 80% here, will be 529, and I gave an example for both corn and soybeans here. Note that this guarantee can go up if the harvest price goes up. If the harvest price is greater than 462, you'll get a higher guarantee than that 529. Here I gave an example of going up to $6 price. We see that guarantee going up to 686. This guarantee increase was very important in the 2012 year. In that year there was a major drought in the Midwest. Projected price, or the harvest price, was higher than the projected price, and RP made higher payments than RP with harvest price exclusion. So that's the basic product, and here's the premiums, or excuse me, the payments that would happen with different harvest prices. 350, 450, and 5 harvest price listed there, as well as yields of 60, 80, 100, 130, and listed there. The crop insurance decision tool also has a what if tool that can be used to create these tables. All right, so most people last year were with RP, 70, 75, 80% coverage levels. If anything, I would say if you were at 70% last year, you might think about upping it to 75%. Who should use RP with harvest price exclusion? And there were virtually no policies sold in Maryland with RP with harvest price exclusion. There were some, but very small amounts. If you're interested in this product, the main reason why you would be interested in this is if you're cost conscious, and I'll show you why here in the next slide. RP with harvest price exclusion will have lower premiums than RP. If I were suggesting this, I would also suggest that you do not do much pre-harvest hedging, and the reason why is in years like 2012. In 2012, we had the harvest price above the projected price. If you did pre-harvest hedging in 2012, you most likely lost money on your hedges, unless you did something quickly, but lost money on your hedges. And RP, if you had a yield loss, will pay you at a higher rate, and in essence protects you and allows you to do more hedging. The other thing is you have to be willing to take the drought year risk of getting no or lower payments. And again, let me just give you an example for corn, Maryland 2012. Here's the acres insured with each of these products: 277,000, 7,000 for RP with harvest price exclusion, and YP 76 premium. Here's the payment per acre, and again we're averaging this over a lot of different units, but our situations, but 77 for RP, 27 for RP with harvest price exclusion, and 33 for YP. That 27 was much lower again because RP with harvest price exclusion had lower payments because its guarantee did not increase with the higher harvest price. Again, if we're looking at RP, here's the difference in premiums. And again, this is Queens and County. And let me just give you an example here. If we're at enterprise unit, $13.75 for an enterprise 80% unit with RP, $9.48 with RP with harvest price exclusion. So you can get lower premiums with the harvest price exclusion. Again, that's the reason why you would take it. RP with harvest price exclusion will make lower payments when harvest price is above the projected price. Here, just as an example, here's the guarantee, and unlike RP with harvest price exclusion does not have that guarantee increase feature in it, and as a result, in this example table, I'm showing payments here for $350, $4, $450, and $5. The red numbers here shows what RP with the harvest price exclusion would pay, and it's more than what RP with the blue, red numbers are RP payments, black numbers are RP with harvest price exclusion. So when you take RP with harvest price exclusion, you do take that risk at higher higher harvest prices that your payments will be lower. Who should use YP? And we still see quite a bit of use of YP, and here's what I would say is that someone not concerned with price risk. If you have the price side of your equations covered, then YP is an acceptable alternative. One thing I would say, though, is if you're covering the price side with marketing contracts, you'll probably find RP a product that might be advisable, because in those years when those drought years like 2012, RP would make payments and cover some of the hedging losses that you cover. Here's just a comparison of enterprise payments from this above table: 1065, 948, 1375. Again, if you don't have the price side covered, you might think about RP with a harvest price exclusion, get some price protection, or moving up here to RP. Again, our YP is a yield protection. It has a yield guarantee. Here's an example of its yield guarantee. It will make payments when yields go below that guarantee. And here's an example of the yield payments. And you can see there it will make payments once it's below the guarantee, once it's below that guarantee, and it will make payments it will make payments on the shortfall times the projected price. Again, summarize here what we're looking at for 2014. 2014, we had the Farm Bill passed, 2014 Farm Bill. That hasn't changed any of the products available for 2014, and I don't really think it should influence your decisions. We showed a bit about the performance of crop insurance in Maryland, and where we see most people at is in the RP policy, 70, 75, and 80% coverage levels. Again, this year I might be looking at RP again. I might also think about increasing that coverage level, particularly if you're concerned about borrowing a lot of operating money, because if we do see lower revenues, we could see losses in 2014. I would also suggest using trend-adjusted APH yield unless you have very low yields. And there are cases in which RP with harvest price exclusion would be a good alternative. Those who are cost conscious and don't do much hedging, and then YP in limited number of cases. We do have time for questions here, and I am going to. We've had a number of questions come in, and the first question is there insurance for grapes and vineyards, and will you speak to this? And I am not sure if grapes and vineyards, if there's a standard policy that exists for in Maryland at this point in time. There are policies outside of Maryland, so that you could use a written endorsement. At the very least, you could use a written endorsement to cover grapes and vineyards. I will look and see what policies are covered on grapes and vineyards, and I will pass that information on to Lori, as well as we'll put a little slide at the end of this presentation just dealing with grapes and vineyards. So if you would, download a revised copy of these overheads, and then we'll put another overhead at the bottom of this discussing the availability of grapes and vineyards, as well as greenhouse crops, mainly tomatoes. Will look at those. Does lower projected farm prices suggest a lower level of coverage? And yes, if we're looking at farm projected prices, so we set those projected prices based on February or Chicago Mercantile Exchange contracts, February settlements for corn. So if that projected price is lower, we will have a lower coverage level. All else being equal, that means that there's also a lower premium. But a number of things from one year to the next could influence the premium. So going from a 565 projected price last year to 462 this year would mean that we have lower coverage levels, lower premiums from the projected price. There's two other factors that will influence premiums. One is what happens to volatility. The volatility can have a big impact on RP premiums. That also happens to be lower in 2014 versus 2013. And then each year, RMA adjusts the rates, representing the underlying risk, and that can influence premiums as well. The lower projected price will lower both the coverage level and also the premiums. Coverage level, again, this year we're going to see coverage levels come down, but by my calculations, costs have not, and so we're at a higher level of chance, actually, of having losses. And in my calculations, losses, if we have crop insurance payments, in most cases we're in a loss situation, even at an 85% coverage level. So that would suggest keeping those coverage levels as up there. Another question: does the new Farm Bill require landlords and tenants to take the same level of crop insurance coverage? Does the Farm Bill require landlords and tenants to take the same level of crop insurance coverage? So that's the question. And crop insurance is available to landlords if they share rent the farmland. So cash rent landlords cannot buy crop insurance. Share rent landlords can. Those share rent landlords can buy different products from the tenant. So the tenant can buy a product, and the share rent landlord could buy a product that differs from the tenant. It could be, if the farmer's buying RP 80%, the landlord could buy any product, RP with harvest price exclusion, at a different coverage level. What we observe, what we see a lot of, is actually a lot of share rent landlords have not taken crop insurance in the past, at least in Illinois, and we actually have been encouraging farmers to tell their landlords that that's an alternative that they may want to take, the share rent landlords. It reduces the share rent landlords' risk, and it may keep them in a share rental situation rather than moving to a cash rent. And no matter what we do, if once we move from a share rent to a cash rent, the farmer has much higher risk. The soybean, another question. The soybean chart had 9% in the RP harvest price category total, but I missed seeing it in the column. Let me go back there. Maybe I made a transposition error. I think you're referring to this number here. Oops. I grabbed the wrong thing. Yeah, that should be 0. I apologize. That should be 0. We'll get that changed, and we'll put a new set of overheads up there with that correction made. All right. Next question. I selected whole farm units because I only farm one farm with one FSA number to get a lower insurance premium. One FSA number does not qualify for enterprise units. All right, that's true. And actually the FSA number, you probably also if you have one farm and one FSA number, you're probably also farming all that land in one section. The question is, can I elect to insure corn at a higher or lower level than soybeans? If you're in a whole farm unit, you're insuring both corn and soybeans together, and you are you cannot choose a different coverage level. So you would have to choose the same coverage level for both the corn and soy. Well, actually, it's a whole farm unit, so you're choosing the coverage level for both of those products, and then seeing in so you only have one choice there, one coverage level. Question: I'm logged in but have no audio and no telephone option. Oops. Sorry, I guess at this point. There's also a comment here. Thank you for this comment. And we had a question earlier about grape policies. There are no policies for grapes now, but we can do written agreements in Maryland. All right, so there's no specific, if you go and look, there's no specific grape policy offered in Maryland, but you can do a written agreement. A written agreement is a special case in which you can get crop insurance, and it will, it's done through a special process called a written agreement. So that's something that you can work with the crop insurance agent on, and getting great policies through a written agreement. Why is it that if you have grain acres insured but also grow vegetables, there are no insurance available except NAP? When there is a disaster declared, that the insured acres are not covered for sure payments. All right, let me read this question again. Why is it that if you have your grain acres insured but also grow vegetables, there are no insurance options available except for NAP? When there is a disaster declared, that the insured acres are not covered for sure payments. NAP, all right, so backing up a little bit, sure payments were under the 2008 Farm Bill. So we had the SURE program, and to be eligible for the SURE program, you had to have all of your acres insured. By the way, I believe NAP would have counted as insurance, but it would likely have cut you out of a payment because of the way the calculation worked. It was average of your insurance guarantees, and NAP is often a very, very, very low level. The 2014 Farm Bill does not have SURE, and it does not have any disaster assistance programs in it. So, and the way the commodity titles are written is that you don't have to take insurance to be eligible for the commodity titles. So the commodity titles in the Farm Bill, the ARC decision, the PLC decision that it will be later on, is not tied to the crop insurance choices that you make. So the Sure Payments is not going to be an issue moving forward. If you do grow vegetables and there isn't a standard policy available for that, you might talk to your crop insurance agent about doing a written agreement for that policy. And I don't know if you might, I'm not sure that that will be an option, but a written agreement can be brought into place for a crop that is currently not insured but is insured someplace else in the United States. So if that's an issue, and if you want to insure vegetables, you might think about talking about the written agreement route. Next question. Are there new options in the new Farm Bill to choose projected prices from? So, no, and the answer to that is no. The projected price for the combo products is set within the policy itself, and the projected price, the Farm Bill did not impact those projected prices. There are a number of add-on products, at least in the Midwest, that allow you to select a different month, or for example, one policy would say your projected price will be the higher of the February average for corn and another month for corn. That is a private product. It isn't part of the federally subsidized RMA administered product. That is offered by a specific crop insurance company. We've seen those products increase in popularity, but the Farm Bill did not change the basic way the projected price is calculated. I believe we've reached the end of our questions. We appreciate your time today. Appreciate your opportunity to you taking your time out and listening to us. We hope that it has been useful to you. Again, I send my greetings from sunny Illinois, which will be snowy tomorrow. Hopefully not, but well, thank you for attending. A couple of notes here. If you want to listen to this again, this will be available on the farmdoc website for download. Let me just go there. If you go to this download site, you can view this video again. The PDFs of the slides is available there now. We will get the error corrected, and we'll get a new slide set up, or new PDF up there. That'll probably be up there tomorrow or later. And we appreciate your time. We also appreciate the University of Maryland Risk Management Agency and Maryland Department of Agriculture for sponsoring this webinar. Again, thank you, and have a good rest of the day and growing season. Goodbye for now.